Hello, everyone. Welcome to Economic Impact. We are Tuesday, April 28th, 2026. Stéfane, great to have you here as always.
Likewise, Nancy.
It seems like nothing happened since the last time we spoke a month ago.
Yeah, many things happened, but we left a month ago. Oil prices were $100. They're back to $100, so nothing has changed. It's still one of the important oil shock that we faced since the 1970s when expressed in $26. So it's a considerable oil shock that refuses to go away.
Something else happened in Canada, right?
Yes, we did get a majority government for the first time in over 5 years. So that might be something to celebrate to the extent that optimal policies are deployed to bring investment back to our shores. That would be a positive.
That would be.
Yeah.
And last time we spoke, now we're day 59 of the Iran War. So what's happening with the Strait of Hormuz?
Nothing happened. It's still closed, unfortunately. And we do monitor this on a regular basis, so I encourage people to go to our website. We have a special product called Monitoring the Iran War, and people will be able to stay informed on that one. So unfortunately, still shut down, and we are running out of inventories. Aside from oil, it's a big deal. So the manufacturing supply chain is still held hostage from the shutting down of the Strait of Hormuz.
So we're all just out of COVID with this shock, and now back to another shock where it's impacting our reality.
Yeah, the last time the manufacturing supply chain was impacted, you're right, you have to go back to COVID. And at this point in time, when you look at the probability by Polymarket of, seeing a reopening of the Strait of Hormuz, you're, roughly 2% for the next, we only had 2 days, right? Not going to happen. And then you're only at 40%, below 50%. So it looks like not reopening before June, so you have another month of depleting inventories. That's going to have an impact on the supply chain.
Definitely. And there's a lot of things that are going through the Strait of Hormuz, not just gas and
No, you're
petroleum.
right. And we mentioned it last time,
yes,
but we didn't show it. So this time around, say, roughly 20% of energy flows, whether it's LNG or crude oil, goes to the Strait of Hormuz. But look at helium, 33%, aluminum production, 8%. This has been destroyed. It's not coming back online anytime soon. You want to do if you want to grow food, you need fertilizers. That's a big deal. Plastic, we have plastic economies. Well, that's also really important. 20% of NAFTA goes through the Strait of Hormuz. So yes, the manufacturing supply chain, I would argue, is more negatively impacted than when we saw the Ukraine oil shock.
Wow. And fertilizers, so finally spring is here in Canada, so we're going to grow our gardens, vegetables, fruits. Probably the prices are going to go higher.
Well, if energy prices go up and fertilizer goes up, I think it's a pretty good chance that food prices will go up. So yes, Ottawa said we're going to give you a rebate on GST, but reopening the Strait of Hormuz would have a greater impact than the short-term, GST rebate. So unfortunately, yes, food prices are going to be increasing in the coming weeks.
And even though this is all happening, we have the best equity market ever.
A new record high. As of yesterday. It's a little bit tougher today. So new all-time high, there are no precedents going back to 1956 for an oil shock that is accompanied with a new all-time high on global equities. It's fascinating. It's unexpected. The market will always find a way to humiliate, people that say, well, I thought it was going to be more negative. The market has found a way, and it's not just, global equities that are up, Nancy. It's even more than that. Every asset class is up year to date. Bonds, you would think more inflation, not good for bonds, but everything is up.
This was negative the last call we did, and now it's back up.
It's back up. So you did have a draw. I'll give you that. Yes, you're right. We did have a drawdown of roughly 8%. But 8% is very small, considering that in every prior oil shocks, you were down at least 20% on U.S. equities. So being down only 8% was quite the achievement when you think about it. And now we're back up 5%. It's a good point, Nancy. There was a market drawdown, but it was very short-lived. And people are saying, no, this thing is going to reopen with no impact on the medium-term economic outlook.
And look at this emerging market.
Up 15. We're not bad. We're the second best. So good news on that one.
So Asia, has a very interesting emerging market, and I guess that's what's contributing to this amazing number.
And they're not supposed to be up because theoretically, they're the most negatively impacted by the shutting down of the Strait of Hormuz because you impact global manufacturing, which is mostly located in Asia. But emerging Asia is saying the best upward earnings revisions since the Asian crisis, which was a massive disturbance to the economy in 1997, 1998. So this is unprecedented. And again, it's also global. So these earnings revisions reflect not just the fact that, yes, Samsung, semiconductors, Korea saying a big revival.
Artificial intelligence, all of that.
Too, but there's pricing power also returning to Chinese producers because they control 32% of global manufacturing. So if you shut down the ability to get inventories from the Strait of Hormuz, if I control 32% of global manufacturing, Nancy, I will raise prices.
Of course.
And it's exactly what's happening right now.
Of course. And if we look at your predictions or the earning per shares expected, not yours.
They're not mine.
The ones that you're showing.
This is company guidance. So we started the year and we said, oh my God, these profit expectations are ambitious, 15%. That would have been 50% higher than last year. That's a big deal. You know where we are now? 22%.
53.6.
Emerging Asia. Emerging countries, generally speaking, yes, 53%. Aside from Japan, everybody's seeing an acceleration in earnings. As I said, we flagged this a few months ago. It says, no, that's quite ambitious. Now it's even more ambitious because people are saying, well, companies will be able to raise prices and therefore protect profit margins. But I don't know, again, that I can promise you that everyone's going to be better off if you shut down the Strait of Hormuz for another month.
Definitely. But those are very impressive numbers.
And if you do, there's going to be higher inflation. And if there's higher inflation, what do you think the central banks are going to do?
Of course. They're going to raise interest rates again. US dollars, in all of these circumstances, what's happening?
It's risk on.
Risk on.
Risk on means US dollar down. So we're back to the cyclical low, back to square one.
So we're not there's no refuge anymore in the US dollar.
No, people are not fearing the outlook. So they're saying we're not taking refuge into it. It's not the safe haven that I need at this point in time. It's a reflation trade. It's a steepening of the yield curve. So people are saying the worst is behind us. I just can't promise you this right now, Nancy, because we don't know the full dynamic of shutting down the Strait of Hormuz for another month. Will I disappoint on the earnings front? And you better not disappoint me if I'm expecting 22% PPS.
Of course. And I know on this you and I don't agree, but even though the US dollar is going down, or back to what it was at the beginning of the year, for us Canadians wanting to go on vacation, because it's May very soon, we don't really see the impact.
That's the frustration of somebody traveling to the Eurozone because the Canadian dollar is at 160 against the euro. And I agree with you, our fundamentals are better than the Eurozone. So I will tell you, we should have an appreciation of the Canadian dollar, but not in time for your vacation. But I do believe that with what's happening in commodity markets, we are likely to be noticed from foreign investors. And I think that could be positive for the Canadian dollar.
That's great. And Canada, it's not just oil.
So listen to this. A cheaper US dollar normally means higher commodity prices. And it's exactly where we are. So energy, which accounts for 52% of our commodity exports from Canada, is at a very high level. But there's not just energy, there's metals. Which is 23% of commodity exports, at a record high. Agricultural products, yes, I know, higher food prices, but some provinces will benefit from that. So aside from the forestry sector, which is being pummeled by
the tariffs and...
Oh my God, prohibitive tariff structure from the US, the rest is doing okay. And that leads to a situation where governments can afford to be a little bit more generous than they had assumed before the Strait of Hormuz.
And there's something special this afternoon?
Yes, we have a fiscal update. And just because of what's happening to commodity prices, I think the federal government will need to upgrade its forecast for revenue growth from 3% to 5%, providing them with the ability to if you want, experiment with new ways of attracting investment to Canada, such as the sovereign fund mentioned by the Prime Minister not too long ago. But notice for some provinces, such as Alberta, which was tabling for only 1.9% revenue growth, they're looking at 7%. So a $9 billion deficit might turn out to be a $20 billion surplus. For Saskatchewan, you're talking about close to 10% because the price fertilizers moving up
Potash and all of
the
that.
potash. Yeah. So that's a big deal. So all in all, every region is benefiting from higher commodity prices, but it's most apparent at the federal level and Alberta and Saskatchewan. So that's the positive wealth effect that comes from higher commodity prices. And that's the reason I think the Canadian dollar could appreciate in the coming months, provided that, foreigners are saying, wow, Canada's for real. This fiscal update to be tabled this afternoon will entice us to invest more in Canada. And we're starting to see it in the energy sector, right?
So I know what you're doing this afternoon.
Yes, I have to monitor what Ottawa's doing, and I'll be debriefing you. It's going to be on our website if you want.
That's great.
And we'll see what happens last month. But yes, the message today again is like, I don't know what happens if another month of shutdown in the Strait of Hormuz. I can't promise to deliver all these profits.
Yeah. So thank you, Stéfane. Always interesting as usual. I guess it's important to repeat that every research that you do and the graphs for the war in Iran, you can follow. You're going to have the link to our website. So definitely, mark this up and go and see every day, every other day, so that we can benefit from your knowledge and the one from your team. And for all of us listening to this, there's a lot of volatility. There's a lot of expectations. So I guess the best thing to do is talk to your advisors, stick to your plans. It's not because the markets are moving that I will change my date of travel or retirement. So stick to your plans, go and see your advisors. And again, Stéfane, always a pleasure to be with you here.
May I say, make sure your jet has jet fuel on the way back, right?
On the way back. To go, it's okay. On the way back, I might have to stay 2 days extra, but we'll see. So thank you, everyone, and we'll see you next month.